What's the difference between a bank and a non-bank home loan? There are two main differences. Number one, the type of loans they provide. And number two, where they get their money they lend. This video looks at the differences in where they get the money they lend and how it affects your interest rates. Banks and non-banks both provide finance, but the money each uses to finance those loans come from different sources. Banks provide both loans and deposit accounts. Non-banks like Pepper Money provide loans, but not deposit accounts. Deposit accounts are a source of loan funds for banks. Bank loans are mostly funded by customer deposits and by some investor institutional investment funds. Each type of funding has a different cost to the bank to use. Accounts they don't need to pay an interest on, accounts they pay a variable rate on, and accounts they pay customers a fixed rate on. Similarly, any investor institutional investment funds banks use have a cost. Non-bank loans are only funded by investor institutional investment funds. In fact, some of these investors are banks. These funds have different costs depending on the type of risk being funded, ranging from low to high. Typically, because of these source differences, a bank's overall funding can cost less than a non-bank, so they can offer lower rates. But because customer deposits make up so much of the funds a bank uses, and they must protect those, they have to offer low-risk loans, which is why they offer less breadth of risk-based options than non-banks. The cost of funds for any lender, the interest rate the lender must pay, is set at a point in time and then used to fund those loans. When the market rate changes, the original cost may not, which is why a change in the market rate set by the Reserve Bank, the RBA, does not necessarily mean a change in interest rates or the same change in interest rates for a lender's loans. The cost of funding for all lenders differs through a combination of market rates, risk, and the cost of doing business, which is why the interest rates for each lender varies, even between the main banks. What this means for you as a customer is that if you see interest rates as your number one consideration, that's great if you fit the bank's criteria. But interest rates aren't always the number one consideration. And if you don't fit the bank's box, you might look at a non-bank solution like Pepper Money. To find out more about non-bank loans, speak to us or talk to your broker.